The stock market is in the red this weekend. The Dow plummeted more than 1,000 points yesterday after the Federal Reserve Chair warned slower growth, a weaker job market, and some pain for households and businesses are likely on the way. He said the Federal Reserve must hold interest rates at a higher level to try to tame the highest inflation the country has seen in 4 decades. And joining us now is financial expert Joe Krier with Tidal Trading. Good morning to you, Joe.
Good morning, Alicia.
Hey, let's do a little Econ 101 here in the simplest way possible. Can you walk us through why those interest rates have to go up in order to fight inflation?
Yeah, and it's an interesting time. You know, you mentioned things slowing down and potentially turning into a recession, but we have, at this point, we have costs running away. At the same time, we're considering the possibility of a slowdown, and everybody's seeing food and gas prices go up due to supply chain restraints. And then we have other prices going up just because there's more money in circulation and demand has gone up for things like travel and other goods.
And, you know, it's kind of a weird time, too, because it's unprecedented because of the pandemic. It's hard to know what's happening with the economy is what it looks like.
Yeah, it definitely is hard to put your finger on it because there's so many factors here. And there's a lot of people that try to point to one or two things. But the truth is there's a dozen factors that go back to 2008 financial crisis when the Federal Reserve had to lower interest rates to zero. And they left them there for years because there literally was no inflation in the economy. And wages had stayed the same essentially for about 20 years. So a lot of things were done over the last few years to sort of spur inflation, get things going. And now they just put a little too much fuel on the fire and they have to back off before this really gets out of control.
So prices did slow down a little bit last month, but the Fed says still that's not enough.
Yeah, there's a lot of problems out there, you know, and we've all seen the gas prices have come down, but the war in Ukraine is far from over. And just yesterday, Russia shut down the Nord Stream pipeline into Europe. So that's going to wreak havoc going into next week. And the problem here is that you can actually have a recession and inflation at the same time if you can't get your hands on enough goods. And so the Fed has decided that the inflation piece of this is a lot more important to fight than the recession piece, because inflation can get going and just run for years, as we've seen in developing markets, whereas a recession usually plays out in 11 to 12 months and things reset and start over. So they're kind of seeing this as an okay outcome, a little bit of a slowdown. And Florida's a little bit immune, by the way, from this, I believe.
Joe, we just have a few seconds left, but I wanted to ask you about the student loan debt that President Biden rolled out. How do you think that's going to affect the economy?
Yeah, I think there'll be actually minimal impact. There are some claiming that that would be very inflationary, but if you look at the numbers, it's about $500 billion spread over 10 years, whereas the stimulus programs to get us through COVID actually threw $2 trillion on the economy in the span of 2 years. So the COVID stimulus is where the inflation is coming from. The loan forgiveness really just helps out a lot of people that maybe had some student debt and never got that education. It's a great investment, but if you have an education and all of a sudden you're paying 3/4 of your income to interest payments, that's not going to work. And the numbers show that this program will target the right people, middle and lower income mostly.
All righty. Joe Krier from Tidal Trading. We appreciate your insight on this morning.
Thanks, Alicia.